What is up, guys? Welcome back to Stocks 101. Today I'll be showing you how to read a financial statement. So we're going to take a random stock here called Metapharm Labs Corporation, and then we're going to go to financials, and we're going to analyze this stock a little bit. This isn't stock I personally own, just by the way. So first of all, when you want to see how a stock is doing, you need to look basically long term at how a stock is doing. So let's go to 1 year, 5-year stocks. So this stock has actually been doing quite poorly over the past year. It was actually really good, $5 back in 2019, and then it kind of just went down. Could be several reasons for that. For instance, the consensus earnings per share has been off target for most part, and their earnings have been in the negatives for the year of 2020. Now that's pretty that's pretty bad. But let's look at their financial statements, because the volume is still quite big and higher than average volume. So let's go look at their financials. So 2018, you can see that they actually had no revenue in 2018, so that's nice, I guess. Let's look here. Yeah, they really didn't have, it was a growing company, I'd assume, and they kind of just went downhill. Let's look at the summary. So March 25th is their earnings date. You don't really know what's going to happen on the earnings date, but it looks like they do have an equity to purchase, which is nice. So let's look at the financial statements. So let's go to the quarterly view on the income statement. So as you can see, they do have quite a bit of revenue that they've been generating from their products, for instance. And their gross profit is also in positives, quite positive actually. Gross profit is basically the sales that they make from their products that they're selling. One of the ratios that I want you to know how to use is called a gross profit income percentage. So basically how you do this is you take your gross profit, in this case 25,169. We're going to be comparing it yearly, so 25,169. I'm just going to put that in here, 25,169, and then divide that by its total revenue. So here, this percentage basically means 20%, 22% of their revenue has been an actual profit. Also here you can see the reconciled cost of revenue, the revenue that they've reconciled, which is the cost, which is very nice indeed. So it's the same all around, 21,971. Yep, okay, good. So basically you want to look at companies that have a 30 to 40 or greater percentage of gross profit income. This basically means that they have a large amount of profit that they're making from the product that they're selling. And also you want to make sure assets is much bigger than liabilities. So here they had assets, they didn't have liabilities. You also want to make sure that the company usually doesn't have any debt. This company doesn't have too much debt, I'd say, but it still has debt that it's required to pay off. Let's look at the quarterly. Yeah, so they've actually increased in debt. That can usually happen if the company is being increased. Let's go look at another stock. So let me just go to my watch list. I'll go to our personal watch list, and then I'll show you guys some of the financials that we have in some of the stocks that I'm looking at right now. So let's look at Athabasca Oil. Oil generally is not too good. Here the earnings statements come in May, 0.46 cents on the dollar. Let's go look at their financials. So here it doesn't look like they actually have financials, which is why I haven't invested in it yet. Oh, it just came up. Nice. So again, let's look at the quarterlies. So compared to 2019, 2018, the profits are down, which makes sense as the pandemic, people's lost their jobs and stuff. But if you look at the quarterly, how it's been doing for the year 2020, they've actually generated a massive amount of profit from the previous years and a very nice amount of gross profit. So if you take that division ratio that we just did, 166,692 divided by 490,633, 33.9% of their earnings are in a profit, which is very nice to know. Compared to the first quarter, they've actually rejuvenated some of their earnings. You can see the cost of revenue right here, reconciled cost of revenue. And then that's very nice. Let's look at their balance sheet to make sure. Look at their debt, how they're paying off their debt if they have any. So let's go to the quarterly. Yeah, okay. So their debt has actually increased quite a bit. Their total debt has gone down, but their overall debt is still still outstanding. You'd still have to pay a lot of money. Now let's go look at some liquidation values if they have any. So diluted earnings per share, basic average, diluted average shares. So in 2019 they did dilute a lot of shares. So let's look at the quarterly. Here it's actually not updated, but in 2019 they did liquidate or dilute a lot of shares here, which is usually not a good thing, but seeing as the company is generating a profit, this would actually be a fairly good investment for a long term. Now let's look at the charts here. This is nice that you want to see a crossover event here, but you'd be buying it pretty high. So if you just look at the 1 month, 3 month, the 1 year, it's all, the 1 year is actually very nice. It's still at the very low point. In 2018 it was $1.53, and it's kind of just gone down to its lowest point, which was 19 cents. So you'd be buying it pretty high. Let's go to, so yeah, what you'd want to see in a crossover over a long period of time, because this isn't a short period. You want the shorter period moving average over the longer period moving average. So that basically means short term it's a long, and then like this here, right here at this point, if you saw this crossover event, this is where you'd want to invest the 19-cent mark, and you'd be up quite a bit. And that would be quite nice. Now their financial statements, let's have a look at what they're saying. Demonstrated exceptional resilience of its low decline assets in Athabasca's pre-COVID plans flash generation. So they actually produced quite a lot of stuff for 2020, which is a very promising. Maintaining production of low sustaining capital, balance sheet Athabasca businesses. So yeah, this company is actually, it was bad, but it actually could be a decent investment for the oil recovery, especially with the oil and stuff. The price of oil barrels going up won't be nearly as much as it was in like 2011, etc., when the company was like at its peak right here to $15 per share. So and they've basically been on a decline ever since. But right here, this is the max, so it's still actually on a downtrend, but for a 2-year period, a 1-year period, it's actually still on an uptrend, which is nice. So you can make the decision that if this thing comes down, keeps coming down, and then it crosses over, you might have a good purchase here. And again, seeing as they did generate a net positive gross profit from the previous years, we can check how much they've made. So let's say 2020 quarter, 66,509. It's actually changed to annual, I'm not sure why. 66,509 divided by 126,708. So 52% is actually a lot, and it's actually reduced, which makes sense because they paid off quite a bit of they still need to pay off a lot of debt, so a lot of that money that they're generating is going to pay debts. I'll show you a company that I'm in currently. It's called Baytex Energy Corporation, which is basically similar to the previous one. This is really nice. They've actually beaten her earnings very well over the past two. They missed the first quarter of 2020. Let's have a look at their financial statements, and I'll show you guys exactly why I decided to invest in this company. So if we look at this right here, the 2021 TTM right here, 1.805, $1,805,919 in total revenue versus before, which was 975. So it's actually recovered. As you can see, it's recovered quite a bit of what it was previously. So this would actually be a very valuable investment, as it's currently undervalued. Let's look at their gross profit and see how they've done. So let's look at the TTM currently to date, and then see how they're doing. 753,992 divided by 1805909. 42%, which is very nice from the previous end of 2020. Let's have a look. 9678552 divided by 975. 477. 69%. So this is actually very nice. Very nice. If you look at the quarterlies, they actually blasted the quarterlies. They've generated quite a bit of profit, so this is actually very promising. And we could just go back to the summary and see what they're reporting exactly. Their earnings come out in May. So let's have a look at what they did here. So here, they've already reported the earnings for 2020, which means the next earning is in 2021. So right now would be a very nice time to buy, considering the position that this company is in. It's very, very good. I believe they used to pay dividends back in 2015. Yeah, so right when the company went downhill like this from here to here, basically down there, I'm not sure what happened there exactly. That'd be quite interesting to know. But yeah, that's a ratio you guys can use to calculate the amount of profit that a company is making and make your decision on whether to make that investment or not. So thank you guys for watching. If you have any other questions, please leave it in the comments below. If you have any suggestions for a next video, please let me know. And don't forget to like and subscribe if you enjoyed this video.